It's great to have you here, Edward from Pledge Capital. Very nice to have you. You're currently in New York?
Yes. Thanks for having me. I'm currently based in New York, born and bred here.
Great. We already had a pre-talk for our conversation, and there you told me something about your mother and her role bringing you to investing. Maybe you want to share it with the others. It's a great story, I think.
Yeah, no, for sure. Both my parents, my mother in particular, but my father as well, both wanted me to pursue a career in investing, and they actually, encouraged me to start my own business. It's been a childhood dream of mine. When I started, actually, she made me promise, if I made a ton of money, that I would give back and try my best to invest in companies on the right side of change. My mom, she's a very interesting woman. She founded a nonprofit, and in a chapter of a nonprofit from Taiwan. She founded a chapter here in Long Island, and growing up, she ran a youth group as well, part of the organization. And every Friday we would go and she would show us a video of some natural disaster. And she would try to convince us to give back and volunteer. So she was quite an interesting character, both my parents. But yeah, that's fine.
But I think your mom brought you to investing and let you buy the first stocks, or?
Oh yeah. So she gave me some money back when I was 12. I think it was like $3,000, and I bought Gateway Computers. It was my first stock. I was researching computers to buy, and I loved the website. I was able to, because they did direct consumer. I was able to buy a cheaper computer. I was able to customize it and add a video card. So I loved it as a consumer, saving money and also just building a computer that I wanted. So and ever since I've been hooked. Right? This was after the tech bubble, so valuations were really bombed out. It was just a very fortunate time for me to start investing. I believe it was a mid-single digit PE, 2003, and pretty much anything you bought made money. I made, I believe, 70% in a very quick time, and I was just hooked. And I just fell in love with investing there and then, and ultimately, decided to pursue this as a career. It was a hobby for a very, very long time.
Before we go that's a good point. You're writing on your page that you're volunteering for the Tzu Chi Buddhist Foundation. I hope I spell it right. Otherwise, please correct me.
You got it. You got it. Yeah.
Since when are you doing this?
Ever since I was little. So like I mentioned, my mom, she founded the Long Island chapter. So I've been part of the organization since I was one. My mom, very lucky to have my mom around as a kid. She would always bring us to the office, and we would play, and she would watch us and do her volunteering events. So it was quite a community to grow up in, right? Surrounded by people who are Buddhist. My father's Catholic, so went to a Montessori, but surrounded by these folks. They make a very positive impression on young kids. So it was a great environment to grow up in.
What did you take away from it for investing?
That's a very interesting question. I think it's a loaded topic, right? I think it plays into a lot of themes that we're seeing today in college. We learn about triple bottom line. Corporate social responsibility. It's this huge debate now, but in my opinion, there's a lot of win-wins, right? You can do things that are good for society and shareholders. And of course, I think there's a lot of issues with ESG investing, but just seeing this shift, for example, in vegetarianism and veganism. Tzu Chi I'm not a vegan or vegetarian, but seeing how society views vegetarianism and veganism and how that's shifted during my life, it's been pretty eye-opening and educational, right? And I think society is always evolving, and companies are evolving, and a lot of the companies on the right side of change, they're evolving with the times, and they're doing things that the consumer want. And I think there's a little bit of this angle with Avid. It's definitely relevant, but companies that find these win-wins could often be, some of the greatest home run investments, if that makes sense.
Yeah, it makes sense. We will later talk a bit about Avid in depth, but maybe let's go back to you lurking around investing and looking for an opportunity to start a business. How long did it take for you to finally decide to go for it?
I started my business when I was 26, 27, so about 5 years now. I'm 32, and I had a career. I started out at Deloitte in their advisory business, and then I switched over to UBS, and I covered restaurant stocks there for a while. But it was always my dream to start my own business. 5 years ago, I had the benefit of friends who are doing similar things. My college roommate, he has his own business now. He started it about a year before I did. And my other college roommate, his wife, she also started her own business, a fashion-oriented consumer business, about a year before me. So I think it rekindled those people, my friends. It rekindled that itch, and my parents were very supportive of it. My father started his own business, decades ago. So having that community around me made a very big difference, and ultimately, it really excited me and really inspired me to pursue this. And fast forward 5 years, it's been it's been a wonderful journey.
How important was it to have this community around to survive the first years?
I think it's very important. Having the right people to talk to, when you're starting your own business from scratch, it honestly, I can understand it can be scary, right? You go through a lot of challenges, and having the right people to lean on, to encourage and motivate you, who have been through something similar. 5 years ago, my father gave me a great piece of advice. It's going to take you 3 to 4 to 5 years to really see if this is working out. So you have to give it time, right? You can't give up in year 1 or year 2. You either decide you're going to give it 3, 4, 5 years, or don't try. You can have a great career on Wall Street, but if you go for it, it can, your life will be very different. In 10, 20 years, you're building something, you're planting a tree, and you're hoping to, harvest and benefit from it, and, benefit from the shade for the rest of your life. So I think it's a very important aspect, your support group, your community.
You named your firm Pledge Capital. What does it stand for, Pledge Capital?
Honestly, I haven't never really gotten into this. I don't typically talk about it with clients, but it's a pledge I made to my mother. She wanted me, 5 years ago, and this is when I guess ESG was still kind of becoming a thing. It's not that powerhouse it is today. She wanted me to try and find companies or look for companies that were on the, were doing good things for society. And to try, right? I mean, I didn't say I'm only going to do that, but to try to look for those win-wins and try to avoid, bad companies, and also to, if I make a lot of money, she wanted me to promise to give back. So that's kind of what played into it. She's kind of the person who thinks if you make a positive commitment, it doesn't help. It doesn't hurt. I mean, it helps with your drive. If you have like another mission, it helps you work harder. And I think, just to kind of, she's had a really big impression on me my whole life.
But it's also the way Buffett has structured his partnership. Like he gave away a lot of in the giving pledge to Gates Foundation of the wealth he has built. If you're looking for this win-win situations, does this keep you away from trouble in the companies you're investing in?
Potentially. I definitely believe sometimes it creates risks, right? If you're on the wrong side of change, it creates unnecessary risk, right? So it's not so much that it's a defensive move, right? It's more, in my opinion, it's more of an offensive move. And you can say there's a great adage that says the best defense is a great offense. And that's how I kind of view the situation. A lot of people like stocks like, Altria and Philip Morris. And I'm not necessarily saying those are bad investments, right? Or, some people wonder or question if all the trends we're seeing in EVs could eventually lead to, maybe in the long term, could lead to some of the oil and gas companies getting into trouble. And certainly I think there's questions around their terminal value. So yeah, for sure, I do think it can keep me out of trouble. But I primarily look at it as a way to identify companies that are making very interesting changes in the world, and who are growing and benefiting from the trends that we see.
With this, you're already describing a kind of uniqueness of your approach. What is also, or what are other factors that are unique to Pledge Capital and your approach of investing?
Well, it might not be unique to me, because I think a lot of really smart investors are doing similar things or the same thing, right? I think there's a lot of investors who like to focus on the small mid-cap space. So that's definitely a differentiating factor for Pledge Capital. Other investors like to focus on companies that, there's some sort of S-curve or a positive inflection point, some sort of catalyst. So I love focusing on companies that are investing in their business, transforming the value proposition for its customer base. And so, I'm always looking for young companies that are doing something really exciting, such as, The Joint, where I think the value proposition was fantastic. And I'm also looking for more mature businesses that are undergoing some sort of change, like Avid, right? Like we'll be discussing. And it's, mature, maybe they dominate a space. A lot of examples like SodaStream is a great one, where, they're investing in some sort of product or new strategy, or just enhancing, the value proposition for their end consumer. And I think when they do that, when they increase their moat, and because their moat's strengthening, it increases their ability to go after their TAM, and grow secularly. And so we love finding great businesses that are doing that. And so that, I think that kind of highlights, summarizes my strategy.
You already mentioned some of the companies you invested in. They have different business models, like Avid is some kind of service for microphone or devices for the film production industry, and also software. The Joint is chiropractics, I think. It's a therapy chain on...
Right, chiropractic chain. So, it's like it's kind of similar to physical therapy. But I look at it as a preventative healthcare company. There's a lot of studies about how if you have pain in your back and you treat it early, you can avoid much more serious surgeries later on. So it's definitely therapeutic. There's definitely this, if you take care of it now when it's a small problem and you don't let it fester, I think there's a big benefit to preventative care. And I think it should become a much bigger thing over time, hopefully.
You also have this Reit that is investing in the house. farmhouses for cannabis. Yeah.
Right. So I feel like that's kind of a little bit trickier. And that's where, I have some clients who will ask me, why are you getting into cannabis, right? So they started out, Power Reit started out owning a railroad track. And they bought it. It's on the books from like 40 years ago. So it's on the books for nothing. And it's grown and appreciated in value as interest rates have come down. And they also now invest in greenhouses, which is a more sustainable way to farm cannabis and also various other products. And obviously, agriculture is a commodity, but they're getting they're investing on these greenhouses where they use less water, they depend on sunlight. So it's a little more environmental way to grow cannabis. And it's, in my opinion, for a lot of cannabis users, that's actually really important, right? They like to hear that. They like to support craft producers who have very unique strains, who are, have a cool story to tell, who I think there's a, Justin Bieber song. He likes his cannabis to come from the sun, right? To be grown by the sun, as opposed to, when under the illegal, era, a lot of this was grown indoors, and it's very expensive to grow it indoors. You need to depend on artificial lighting, right? It's more costly. So greenhouses actually have a cost advantage versus indoor farming. And while there are, investors who believe that outdoor is a risk, it's very hard to optimize, outdoor growing. If you look in Canada, there's a company called Delta 48. I forgot the exact name, but it's really tough. You're dealing with a lot of, outdoor challenges. The wind, the water. It can all hurt the plant, the crop. It can reduce its quality. So a lot of the outdoor stuff is actually, for it's used for extraction. And ultimately, I'm actually a little worried. I think there's a company out there called Amyris, and there's a couple other kind of biotech companies. They can synthesize THC for much cheaper than outdoor growing. So if I had to look out, 5 years, it's assuming cannabis is legalized, you probably have greenhouses that are creating cannabis for people, the traditional cannabis products, and then a company like Amyris or other biotech companies who are synthesizing THC at much cheaper costs, and that's what's supplying the edible and concentrate market. So that's an interesting company too. We've done very well with that investment.
Thank you for the insight across your portfolio, but I was wondering a bit when I read about your investments, what do they have in common? What is there a common pattern you can identify?
So with Power Reit, it was I like growth, right? I like to find value stocks, but I think it's the value growth debate. It's kind of a moot argument, but it's like yin and yang. You can't figure out growth, or you can't triangulate growth without knowing. You can't know value. You can't triangulate value without knowing the growth story. So, some commonalities, going back to the two buckets of stocks I like. Power Reit was undergoing a transformation, right? It was focusing on a new area, right? And when I found Power Reit and when we invested, I believe it was trading at half of the, NAV, right? The price that we paid, right? A mid to high single digit high single digit price. The assets on its balance sheet, were carried at its historic value. Same with Avid, right? And Avid was, we originally pitched it at a year and a half ago, and it was trading very cheap to what I thought the brand was worth, what I thought the earnings power was worth, right? So for both Powerade and Avid, kind of a single digit price to owner's income, right? Kind of multiple. So and Avid was also undergoing a transformation from perpetual to SaaS. And I think that's a great transformation that by itself creates a lot of value for it lowers the entry cost, right? It lowers the investment cost. So it's great for new users, low friction to try it, right? They had a free product. They have a $25 per month tier, a $50 per month tier. So it opens up and it enhances their conversion, and not only that, but they were investing in their product. Now we're going to Avid. I think they had a great management team that was really focused on the product and investing to simplify the product, enhancing the user experience for the core user. And so I like that transformation at both Reit and at Avid. So it kind of fits into one of those two buckets I laid out, right? A company that is going through some sort of transformation in investing in its business, taking it into a new direction. And so I guess the commonality with the joint is a little bit, it's different. Although I think with the joint, you definitely had a similar pivot, but this is kind of years ago, not as relevant now, but we're seeing it play out, right? Their focus on regional developers. These regional developers, it was a model kind of rolled out, I think, 5 years ago, where they're recruiting, and I've spoken to a lot of these regional developers, and there are people with skin in the game, right? They're usually successful businesses with a lot of connections. And oftentimes, most times, they own one or multiple joint franchises. And they go out there and they, lever their networks to sell the joint, right, to their friends and to their connections. And I think a lot of companies, when they're scaling, they encounter growing pains. And regional developers not only help you grow, but it can actually reduce those growing pains. By having someone with the skin in the game to coach new franchisees, you reduce problems from arising, in my opinion. So I really like that, Peter Holt focused on this strategy, using and leveraging regional developers. And in my opinion, it really enhanced their ability to grow quick and grow sustainably. So I guess that kind of is a common thread, right? It's some sort of underappreciated pivot that others just haven't seen yet. And I love finding those.
So you like to dig in value names that can become long-term compounding growth names? Yeah,
because obviously growth investors, they've had a wonderful run, multi-decade run now, and so I think it's important to buy what other really smart investors will come to appreciate, right? So my opinion is if you can find value stocks, and I mean the joint wasn't necessarily a value stock, but if you can find these stocks that other really smart investors will want to buy and own long term, I think that's a path to very strong returns. So definitely love mining within the value universe for stocks that I think are undergoing some sort of transformation and can be viewed as compounders. And that's the goal, right? To find a stock that can go up 2-3x, and then at that point, you've grown your confidence in management, and you believe in the story even more, and you think it can go up another 2 or 3x in the next 3 years or 5 years. And I think that's the dream, to find these multi-year compounders, with very, very attractive and strong investment stories.
What makes you say yes to an investment? Or let me reframe the question also a bit. What are the hurdles for you to say yes?
A lot of investors have checklists, and I try to have a very simple one. I love finding companies that have a moat, that have some sort of, and because they have a moat, they can execute and deliver on their TAM and actually achieve that TAM. So those are two very important characteristics. And then I love finding great businesses, right? So with Avid and the joint, one area that I like to focus on is businesses with high margins, right? And both of these have high margins, right? The franchise business and the software business within Avid. I think that's a very good business model. They're both subscription type. Well, the joint is not exactly. It's a membership, shorter, I guess, lifetime, but kind of a recurring revenue base. So I really like these recurring revenue models. Power Reit for sure is similar, right? It collects rent, and so that's so. If I had if I had to lay out my simple checklist, it'd be a good business that can generate an attractive return on invested capital, and management team is important too. But I kind of, not only I think is it important to identify good management teams, but I think management teams that are kind of undervalued and people don't necessarily believe in them yet, right? Who are kind of becoming or who can become recognized as great management teams. So I love what Peter Holt did with the focus on the regional developers. You want to look for management teams with a lot of skin in the game, right? So, with Power Reit, the CEO owns like 30% of the company, and he just invested, I believe, like 15 million recently. He bought shares. So those good business, good management team, a moat, and a good TAM, a good secular growth story.
What are your measures, or what is your framework to identify a management team that's undervalued? Or
that's really tough. Definitely really tough. I typically want to see them investing in the business, right? Not necessarily buying back shares or doing things that investors want, but doing right by the customer, right? Like making solid long-term decisions, right? And I think. So, for example, like I think ANGI is an area where I think there's a lot of question marks. But when I look at that potential, when I look at that potential opportunity and that management team, I do believe they're executing in the right direction. That you can't argue that. I think they're moving the product in the right direction, and there's a lot of examples of that, right? So, I think. Good management teams, a lot of times we're kind of looking backwards, and I try to have somewhat of a more forward-looking approach. What are the management teams that are investing in their product, thinking long-term, and really trying to build something that's just way better than what exists now.
What is your ideal time for investing in a stock? Like, how long do you want to hold it? How long-term are you in your commitment to be invested?
Well, so we're still invested in the joint, and it's one of our biggest positions. We've held it, I think since 2018. early 2000, March 2018-ish. And ideally, we want to hold stocks for 3 to 5 or even longer, right? I mean, I think when I build out my models, I'm looking out 6, 7, if not 8. Yeah, I think once you get to like the 10-year market, it becomes harder. I think my sweet spot in terms of looking out is really that 4 to 6 year mark, where I feel like, I have a lot of confidence. If this, if they're investing and, this is kind of like where, how long I'm looking out. And for me, it's also like I have to balance. I'm trying to make as high of a IRR for my investors as possible. Those are my incentives. So it doesn't necessarily make sense for me to hold super long term, like 7 to 10 years. But I think there's a lot of alpha to be made, investing with that 3 to 5 year time horizon, which is already quite a deal longer than a lot of other traders and other market participants. And once it becomes super recognized and everyone knows the idea, you start to lose your alpha to some extent, right? And I do look for punch cards, right, that I will always want to hold, but maybe not to the same extent, right? I mean, we can run pretty concentrated. I do kind of have like a mental, size of say 25% of the portfolio, and I have held a position of that size for 3 years, 4 years, and Avid we obviously plan to hold for a very, very long time. So it depends, right? A lot of it depends on the situation, right? Or we're always monitoring the risk. If the risks become a problem, that's one reason we'll move on. If the IRR drops significantly and we see other really attractive opinions, our portfolio some positions could be kind of more of a cost of capital for us, right? Maybe the IRR has dropped but they become kind of the hurdle rate to some extent, right? Like you understand the story very well, you believe a lot in the management team and in the investment story. So you have to weigh all your opportunities, all your new opportunities against that. And if we find something where we really believe in, we'll look to trim, right? We'll look to trim into big moves, and so that we can finance other investments. So that's kind of how I think. I do want to try to hold positions for a long time, because I think that's one of the biggest mistakes you can make. Kind of thinking back to this Philip Fisher quote, right? Billions have been lost by, the gist is that billions have been lost by investors selling too soon, when it would have been more prudent to hold on, because those investments are still going to be multi-baggers. And that's why I'm that's kind of my thought on Avid right now. And yeah, so I mean, we can talk more about that.
Before that, maybe you said you have this 3 to 5 years time frame where you build an investment. What is the return you expect from an investment in this time?
Typically we're very interested if we can find an IRR of 30%, right? Maybe 20% on the low end. Sometimes you find things that are a little higher than that, and obviously the IRR, it's just kind of our best guess, what we're willing to underwrite. And that's the kind of IRR that I feel like you can find in that 3 to 5 year time horizon. And sometimes they get brought forward, if it's a particularly compelling story, it can occur a lot faster. And, the long-term IRR will fall. And go from 30% to say 15%. If it's a very strong story, I think that occurs for exceptional, extraordinary companies.
So let's go a bit into Avid. one
sure.
position you like very much. How did you come across the idea? What was the first time you heard about Avid? And
Actually, it's from a friend of mine. He was a roommate of my roommate. Good guy, very smart investor. He told me, we talk a lot, and I've been an investor in Autodesk, in Adobe. We've made money in those businesses. Love that subscription, media, right? In architectural, focused products. And so he thought Avid was right in my wheelhouse. And so, he recommended it to us to take a look. And so that's why we did a pretty deep dive, and we saw a lot of characteristics that we liked. It helped that we had a client who is a movie editor, and we were able to do a lot of due diligence, talk to a lot of different users. I grew up with a childhood friend of mine, who went to NYU with me. He went to Tisch. He's also a movie editor. So just loved finding this company that had basically persisted for the better part of 3 decades. Well, about 3 decades, right? Like it's kind of like a weed, right? Just all these big, giant, gorillas and elephants trying to go after them, right? For years, investors were worried that they were going to go away, but their core users are very loyal, and for a lot of reasons. It's kind of like Excel for us, right? There's Google Sheets, but if you paid me $100, I honestly don't think I would switch if that option was there. I prefer Excel. So for Avid users, all their shortcuts, they know all their shortcuts. They have their setup. They've been using it sometimes for a couple decades. And not only that, but it's not only just Excel. It's kind of like a hybrid Microsoft and Excel, right, where they have plugins. So it's almost like the operating system with apps. With all these plugins that are very important. So that's what initially drew me to the business, and that's how I found out about it.
What else did you like about Avid?
With Avid, I really liked the management team and the risk reward, and just the potential there. And let me elaborate. They're very dominant in Hollywood. It's vast majority, right, of Hollywood movies and TV shows are edited on their software. And kind of going back, I wanted to bring in the fact that hardware is a very important component. The integration between software and hardware is very important. A lot of big studios, and big clients, they just don't want to switch to something where there's a lot of different vendors. It isn't as well integrated, and they're working on multi-million-dollar projects, and it's just not worth it for them to save on their Avid subscription by going with someone else. It's just a cost of doing business, right? So, kind of going back to your new question, what else I liked? So the management team, the opportunity, the potential. I think prosumer has always been called out by investors as an opportunity, but I actually really like that this current management team was investing in their core product, right, before really going after this prosumer activity, right? The prosumer activity was always an opportunity, but you can't take your eye off the ball, right, which is your core business with your Hollywood studios. So they were investing into that business, right? Developing cloud products, developing SaaS products, really focusing on security and reliability of their cloud-based solutions. They were listening to the Disneys and HBOs of the world that were kind of thinking. There was a media consortium of studios laying out the move into the cloud, and Avid was listening. right? They were investing in this area. They were looking for partnerships. They rely a lot on third parties, right? Plug-in developers and partners like Microsoft to help them. And so I really liked that they had a product-focused CEO, right? He was the product guy who took over as CEO. And if you give the product guy the reins, he's going to invest in their product. And I liked what he was doing, investing in their core instead of solidifying their moat, and listening to customers, solidifying that competitive advantage around their core business before attacking prosumer. And I believe that's playing out, right? I think at this point, the moat for the core business has moved in the right direction, and we're seeing tangible results. It's obviously been accelerated by the pandemic. The pandemic broke the mold. It made customers believe you can trust these, very highly paid editors to get their job done, right? If they work remote, they can deliver on time. So it broke the mold and broke the thinking that existed for decades, and there was kind of this cultural, inertia. So it changed that and accelerated the shift to remote, and it also made, disaster preparedness, resiliency of your infrastructure, like very important topics for IT executives within the media industry. So definitely the pandemic helped, but they were moving in this direction. So, and just the last point on this, it's very hard to get a professional to consider a prosumer product. In my opinion, I think it's tough. So to solidify that and then shift to the prosumer market, where I think the tables are completely different. It's not as hard. In my opinion, it actually could be easy to convince a prosumer to consider a tool that's used by all the pros, the best content creators, or in the world. If you make it simpler, right? If you make that product simpler, if you enable more cloud collaboration. So Pro Tools is a great area to dig in and to explain that. And if you lower the price to $25 or $50 a month, right? So we heard a great story, talking to a musician, for example. He's also a music teacher. And he has students who are literally selling fruit roll-ups or candy on the bus to afford a Pro Tools subscription. I mean, I think that's just incredible. And it speaks to their opportunity in the prosumer space, where they have a very small market share, and the market, frankly, is just multiples, an order of magnitude larger than the professional market. So I really like that potential and that risk-reward setup.
Maybe we can go one step back and you explain what kind of products Avid offers and
For
what
sure.
are these new products they launched.
Yeah. So, Avid historically, going back 30 years, they helped create, or they created a product called a nonlinear editor. And before this, right, I was learning, you had to do it by hand, right? There's a machine where you were looking at individual film and you were slicing and combining it together. And it was still done for many years after, but NLEs digitized this, I guess, organizational. In the beginning, it was an organizational, like you were able to fit clips together, and there was, media management. So, you can go back and actually find those clips, match it with the digital version and put together the final product. But then, eventually all of it was done online, right? I think a lot of it, more and more of this is just done digitally. Sorry, not online, digitally, where you're ingesting videos into, a computer and just editing it. So that's what Avid does, right? And they acquired Pro Tools, I believe, in the mid-90s, and it was a similar product, right? Both products, right? The Media Composer product basically was a first mover within Hollywood. And it was used by Disney and various other studios to, cut everything from, long movies to TV shows to commercials and So pretty much everything on Netflix, there's probably 80-90% chance that if you're watching on something on Netflix, it was cut on Media Composer. And then Pro Tools is Media Composer, but for audio, right? And their market share within the professional music space is maybe not quite as high, but a lot of music created by most famous musicians are cut on Pro Tools, and so that's what they do. It's a digital, and obviously they've branched out. They do a lot more other things now. They have control surfaces, mixing equipment. They sell a lot of storage, both physical storage as well as cloud storage. Storage is actually a very recurring business as well. Hard drives tend to fail, or the IT departments start to worry about hard drives failing after 4 or 5 years. So there is an impetus to replace it every 4 to 5 years, and storage continues to grow, and it's going into the cloud to some extent. So it's a business with a lot of different segments.
And what did management do right for you that you could identify it as a value driver, and how did they execute?
Well, so like I said, with the cloud product, there was something called Avid on Demand, right? This is a new product that they've been creating. And they've worked with Azure, they work with Equinix and various digital infrastructure companies. And basically what it is I think the idea probably came from the gas industry, gaming as a service. So NVIDIA and a lot of other gaming companies, they created a product where there's a virtual engine running all this data and all this, all the engines. Like gaming, video editing is a very, very, compute intense product. And so, and not only that, but if you have a virtual editing machine, you can spin it up and spin it up down from anywhere. You can access it from anywhere in the world. So it's really good for remote. It's really good for these teams that work in different cities, project by project. So they basically they listened to their clients, and they created Avid on Demand. And when we first started taking a look, this is more of a proof of concept, right? They were working with studios to test it out. And now, they just recently formally launched it. And so a commercial version is now available. And it definitely seems like, that's the way of the future, right? Because if gas is possible, there's no reason, the original thesis is that if gas is possible, and we spoke to, some engineers around this, I've had a lot of conversations with, people involved in the data center industry, like Equinix or Digital Realty, just to understand this, how whether this is possible or feasible. And so, I guess the general thesis was that if gas is possible, and this is, if gas is going to enable the Ready Player Ones of the industry, then, Avid had an opportunity in that it was possible for them to create an edit, a virtual editing machine, right, to help with, video editing.
What did you do to get a certainty? What was your research process to say, I want to invest in Avid, besides doing all of those interviews you already mentioned?
I think Philip Fisher is just, I think, a great teacher, and a lot of the things that he teaches, or the lessons and case studies that he shared, they're so relevant today. And in fact, perhaps they've become even more relevant over time. So everything that he talks about in his book, I think, is very important to do. So even just, you mentioned the scuttlebutt research that we do, talking to a lot of industry insiders, talking to, resellers and implementation providers, talking to people who are involved with the tech stack. We, talking to competitors, right? I like to consider, I want to consider things from everyone's point of view, right? The customer's point of view, right? So getting into the mind of the customer and the end user, and also different types of end users, right? Like, so my wife's a podcaster, considering whether or not it's ever possible for her to use Pro Tools, and whether or not a vlogger, right? The tens of millions of people posting video content on YouTube, whether it's possible they will ever consider Avid. So I think all those important, right? Considering the thoughts and what's going on behind the brain of the different stakeholders or the different parties, in this ecosystem. So, we also like to dig into the history, so looking at the former management team, and I think what was an early pivot into prosumer, I think they weren't quite ready for that back then. And, this time it's different. I think there's a lot of evidence to that. So, we spend a lot of time digging into that. Of course, I think, everyone digs into the filings. We love looking at the, past 2 or 3 years of transcripts at least. Coming from the sell side, I used to be the model guy. I built all the models. I've built over 100 models the last, 5 years. That's a very important part of our process. I think there's a lot of smart investors who can maybe do that in their head or do it on the back of envelopes. And, we try to do that. We that's a starting point, but in our opinion, we like to build models of, every company that we invest in. And it's important for us to consider the long term. I think it makes it a lot easier to consider, what do the financials look like? When they report the 10Q and 10K, what does the balance sheet, income statement, and cash flow look like, right? And thinking through all the different moving pieces, I think a model helps break it down. It may not always be necessary, but it's a kind of a checkbox. It's better safe than sorry. So we spend time doing that as well.
What did you buy into when you first bought Avid? Was it the existing business and the optionalities you gave a certain value, or what is?
Exactly. So, there's a lot of uncertainty with optionality, right? But I don't think you can, in order to be, I think, a successful investor, you have to assign value to optionality and upside potential. And now, obviously, there's always, I think people are always hesitant to do that, especially at a all-time high when it's like going back to Ben Graham and his Mr. Market, case study and teaching. No one wants to be the greater fool, and you never want to be like the last person who gets in, because of the high price and the excitement. You underwrite this magnificent story, but you still have to you definitely have to consider that optionality and that upside, and it takes a lot of work, right, to get confidence behind it. And you obviously want to try and predict that before the inflection point, before the S curve. It's not always easy to do that, but you're right, that's what excited me, finding a company that I thought was investing in its business when it was approaching that point, and potentially approaching that point in a year or two, right? And having confidence that they were. That's right.
How are you generally going about this optionalities, trying to give them a certain value in your models, for instance?
Yeah, so we like to play in our model, right, different scenarios, right? And so, in the back of these sell-side research reports, you had, and I used to update those, you would have a bull case, a base case, and a bear case, right? And so to some extent, it's basically a judgment on the risk, right? What is the downside, right? Like, and you have to think through, okay, so this is the worst case scenario. This is the best case scenario. And, it's one thing to do that. I think it's a lot easier to do that. What's harder is actually figuring out, how confident you are that the bull case is actually going to come around. And I think it's really important to play out and think through those scenarios and really think through the risks, right? For Avid, it was, I love the setup where for years and years, for a decade, if not more, right? 15 years, right? So since Final Cut Pro, I think investors were just worried about the risks that these two gorillas were going to come in, right? First Apple and then Adobe, that they were going to come in. And there's this narrative, right? And it was supported by a lot of quantitative, right, factors, right? Like Avid saw pricing decline for the better part of 3 decades, right? The pricing for their products drop, right? In response to, Apple and Adobe and, much cheaper competitive products. And that fed into the narrative, the investor fear that this was not a sticky product and that it didn't have staying power and it was only a matter of time before Avid went away. But that didn't happen. They persisted for, like I said, for basically 3 decades, like a weed. Even though there was cheaper alternatives or maybe even, free alternatives, the vast majority of their user base just never wanted to switch. They were always finding one excuse or another. And I also frankly think it's a better product, tailor-made for professionals. But it was really that confidence that I just don't believe a company they're basically the only company, right? Avid alone is investing into SaaS, not into cloud, right? Into the SaaS cloud product, virtual editing. It's not a focus area for Apple, right? These businesses are giant conglomerates. They have, this small professional Hollywood, business is not their core focus. And it's also, frankly, just a drop in the bucket. So losing half a point to Avid, right, of market share to Avid is nothing. But whereas for Avid, gaining half a point or a point of market share per year, it's very, very meaningful. So that they benefit from that focus. So looking at the bear case and figuring out, do I believe the bear case is going to happen? And then looking at the bull case and figuring out, is this something I believe in? And when I looked at Avid, I just didn't believe the bear case was going to play out, right? They were addressing a lot of the problems that I think that investors critique them about, right? For example, like education. I think they're doing a really good job in education, reaching out to educators in the North America market, maybe less so in emerging markets or even Europe. I mean, I think they're moving in this direction, and they're doing a pretty good job, very good job in North America with universities and getting their products in the hands of up and coming content creators, right? You get them early, and just not believing in the bear case and believing in the bull case. That's what really got me on board, and that's like kind of what pushed me over to take a position. And initially, we didn't make it, a very big position, right? It was more of we saw a lot of potential, and we saw a lot of potential upside. And it was a business. We wanted to see the proof of concept for cloud work out in a commercial version. We believe there was a prosumer opportunity, but we wanted to get more confidence around that and for management to really talk about it. Because when we got involved a year and a half ago, the marketing officer was complaining about never getting marketing, a marketing budget, enough marketing dollars to throw at this prosumer market. And she talked about the phenomenal LTV to CAC that she was seeing, right? She's basically saying it was infinite. It was like thousands of X or whatever. And so we liked that setup. We really liked the potential, and we thought, well, if they execute, we can add. It's going to grow organically. And so for me, Avid it's quickly becoming a potential punch card. Like, it's worth asking, is this a punch card investment, right? Can it become a punch card investment, right? It has a strong product, strong competitive advantage, right? Sticky. with its core user base, it's extremely sticky, right? It's persisted, it's existed for 30 years, and huge companies have tried, and in my opinion, they're not succeeding in destroying their share in the professional market. And then there's strong growth potential, right? There's growth potential into the cloud editing business, where, you know, maybe they can double their ARPU or triple their ARPU over time, right? From, you know, storage and this cloud editing business. If you can break it down, there's an upcharge. It's definitely an upcharge. There's also an upcharge from switching from perpetual to subscription. They've called out you know, an upcharge there, and so it's worth wondering if this is a potential punch card, and, you know, it's not valued as such, right? It's, you know, I think it's a $36 stock. Management thinks, you know, in 2025 they can make up to $4, right? So, you know, I think people are obviously, you know, bidding up the stock, but for me, you know, I think it's justified. It's, you know, people are paying, you know, what I think is a fair price for a company of its quality, right? And for me, you know, at this point, I'm trying to, you know, remember the words of Philip Fisher. You know, you don't want to sell too early. You know, billions are lost by, you know, investors who get out, and, you know, a stock could still be a you know, very profitable investment long term. So yeah, those are my thoughts.
Is there anything you want to add on Avid?
No, I think we covered a great deal. Yeah.
So what is your thesis on ANGI? Hey, Tillman here. I'm sure you're curious about the answer to this question, but this answer is exclusive to the members of my community, Good Investing Plus. Good Investing Plus is a place where we help each other to get better as investors day by day. If you are an ambitious, long-term oriented investor that likes to share, please apply for Good Investing Plus. Just go to good-investing.net/plus. You can also find this link in the show notes. I'm waiting for your application. And without further ado, let's go back to the conversation. And thank you very much for the insight into ANGI.
Yeah, happy to. Yeah.
For the end of our interview, I want to ask you about a quote you have on the front side of your material. Mm-hmm. Social responsible investing can be highly profitable. What is the theory behind it?
So I think there's a lot of trends, right? I mean, if you look at consumers these days, more and more, I think they're willing to vote with their feet and their dollars behind, you know, socially responsible, right? So it's not just things that are just no-brainer good for them, right? Like an ANGI, you know. So for example, Avid, right? In Hollywood, I think you have a group of individuals, perhaps more than any other industry, who care about environmental causes. And so not only is remote work potentially good for them from the point of view that you can avoid an LA rush hour commute, but it's also environmental, right? You save on the, you know, the smog and the congestion and just all those, you know, carbon emissions. So, you know, more so than any other industry, I think that is a potential factor for adoption of a cloud-based editing software. And so when you look just more broadly, right, and I think I have a case study on SodaStream where we talk about the aspects, right, that, you know, consumers care about, right? The health benefit of drinking seltzer versus soda, right? So encouraging more encouraging more seltzer consumption, right? In addition, right, and that's on top of you know, saving, right, reducing our plastic consumption, right? Because if you're buying soda at, you know, from the grocery store and it's also heavy to carry back, right? So they did some really interesting marketing around that. I think it's really appealing. In addition to, I think saving money, right? So in addition to the convenience of not having to carry all of this heavy soda, containers of soda, you're also saving money. In addition to that, there's also that angle where it's healthier to drink seltzer, and also, it's more environmental. So, I'm not necessarily saying that ESG is the only way to go. I think there's a lot of great investments to make that are not ESG focused and just strictly just focused on consumer, consumers just getting a better value prop. But I love it when I find a company that is not only increasing the value prop, but doing something that a lot of more and more consumers care about, right? Because it enhances, in my opinion, their growth potential and the story, and the investment story there.
Coming back to the offspring of our conversation, your business, where do you see Pledge Capital in 5 years?
I've been very fortunate. The last 5 years we survived, and this is what I love doing. I try more now to just take time off on a Saturday and just try not to look at stocks now. But it was a hobby for me that became a profession. So I'm so happy that I can just continue to do what I'm doing. Hopefully I'm managing more money. What I'm really focused on is just looking for new companies on the right side of change, finding those stocks and really, delivering really strong performance for my clients and my partners. That's my first and foremost goal, to do right by them. And hopefully just organically, we're going to grow just because we put up good results. And as people understand our long-term investment strategy, will grow organically. And so, hopefully that happens as well. But I'm already very grateful with what Pledge Capital has become. It's been a wonderful run already.
Is there anything you want to add for the end of our interview?
No, except I'm always love networking with like-minded individuals such as yourself. So happy to chit chat on ANGI, Avid, The Joint, any other names. You can find me online. Just reach out. I'm on Twitter at Edward.Chang. You can reach out to me on LinkedIn. Always happy to connect and share anything, answer any questions, or talk any interesting stocks. This was a pleasure. Thank you so much for having me on, Tommy.
Thank you very much for your time and your insights. They were really interesting.
Awesome.
Thank you.
Cool. Hope it's helpful.
And bye to our audience.
Bye, everyone.
Bye. As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.